Good afternoon, everyone. My name is Mitchell Snedden and I'm the Head of Portfolio Services here at InvestSMART. And what we're going to be talking about today is looking at getting the investment ball rolling. Now, when I came up with that name and this presentation, it's to look at two key things. Either one, if you're young and you're looking to get into the stock market and start investing for yourself, where should you start and what are the little first stepping stones you need to come across before you get going. But secondly, looking at how to invest for children or grandchildren. Now, the topic came to mind when a number of our current separately managed account clients contacted us and wanted to set up investments for their grandchildren. So looking at, say, starting off with $5,000 as a little nest egg and then having the dividends reinvested and growing from there. So we've put in quite a few of those in place recently, and there's been quite a few common questions that come up when doing so. And so that's what we're going to be walking through today. Now, as this is a live event, you'll be able to ask questions as we go along. So just below the video box on your screen there, you'll see a section where you can put your name. Then once you've set that, you can put a question as well and send it through. Now, I'll be moderating those questions and then covering off those questions at the end. If you don't see your question pop up just below, don't worry. We have received it, but do keep sending them through, and I'll get through to those at the end and publish those as I go along. So the very first slide we're going to get into today is the most important slide of the day, and if you've ever seen any of my presentations before, you'll know that it's the disclaimer. So the disclaimer here, we'll be talking about some general investment advice, and it's general in nature only, as I don't know your personal circumstances. And now we will be talking about some tax implications as well when investing for minors. So this is very important to please go and consult your accountant or financial advisor before undertaking any of this, because it can, if you are investing for minors and depending on the investment structure, it can have some implications for yourself personally. So do go and see your accountant or financial advisor just to make sure that you're doing exactly the right thing for yourself before you go and invest for minors. Now, onto our first slide here, and we saw a recent ASX study come out which basically told us more and more young people were starting to invest year on year. I guess because things like are out there that make investing more accessible to people, and there's a number of new products out there with low entry points that younger people can afford to invest in. Also, of course, we've seen the housing market being incredibly hot, and the topic of millennials not being able to afford houses because they're buying too many smashed avocado breakfasts has been quite topical. So perhaps a number of them are turning to the stock market with their savings rather than looking at the property market because of that. So as I said, we've seen these numbers rise quite considerably. One thing that's caught my eye though specifically is a large portion of those individuals from this study said that they were after conservative or guaranteed returns. Now, when you've got a long investment horizon in front of you, looking for conservative or guaranteed returns might not be the best investment approach for you. The reason for that is the longer you have to invest, the more you can wear those ups and downs and those bumps of the investment markets. So that means the more high growth asset classes you should have exposure to. When we say conservative or a balanced fund, you're looking there at having a mixture between Australian equities, international equities, property, fixed interest and cash. Now, the more you go up the scale of high growth or aggressive, or the more growth asset class exposure you have and the less cash and fixed interest exposure you have. When you go back to that conservative side of things, you're to get that more guaranteed or stable return, you're going to have to look to have more fixed interest and cash in that portfolio, which is going to hamper your long-term growth prospects. So this next slide here shows a breakdown of what our conservative portfolio looks like and our high growth portfolio. And this is our internal portfolios that we manage for clients. So if someone came to us and said they wanted a conservative portfolio, you can see here we'd be giving them just 31% Australian equities, a tiny little percentage there of international equities, a little bit of property, cash, but predominantly fixed interest. So 42.7% of the portfolio would be fixed interest, and that's where you're going to get that guaranteed return from. But of course, with guaranteed returns, they come at a much lower level than those higher growth returns, which aren't guaranteed. So you can see in the high growth portfolio here that Australian equities is 24%. We've got quite a large exposure there to international equities. Property is roughly about the same level actually in the conservative fund. Cash is about the same level, but fixed interest is is decreased greatly compared to the conservative. And so for younger people looking to invest in the market, especially say their super fund, which they can't touch for a long period of time, if you are looking at getting more hands-on with that through various investment vehicles, have a look at what your structure is. Have a look if you're in a conservative, balanced or portfolio, or if you're in a growth or a high growth portfolio, because generally speaking, the longer time you have to invest, the more growth assets you should have exposure to, and the less fixed interest in cash you should have exposure to, and that'll help you in the long run, most definitely. Now, I just put up there our conservative and high growth portfolios. If you were to go on our website, you won't actually find those. What you will find are our core products, and you can create those portfolios by adding to those core products. So for example, to get the high growth portfolio that I just had up there, what you'd invest in is with your 100% of your capital, you do 80% in the core growth, InvestSMART core growth portfolio, then you do 20% into the international portfolio. And that will then give you that right blend to create that high growth portfolio for yourself. And conversely, with the conservative portfolio, instead of adding that component to international equities, you dial that back and add it to fixed interest, and that'll give you that conservative portfolio. Now looking at, for those who are unfamiliar with really how stock markets work and the short-term and long-term effects of investing, the reason why younger people, be it your grandchildren, your kids, or yourself, you could, looking at the long-term horizon, why you should focus on the longer term and have more growth assets in your portfolio. Over the short-term period here, we've got the ASX chart to date. This is 1 year. You can see quite volatile on a condensed period. So that's why if you are, say, looking to retire soon, you might want to have so much of your assets exposed to these gyrations, because who knows if that market will drop just before you do retire and impact your retirement savings. But if you're at the start of your investment journey, like a child, grandchild, or yourself, then we'll have a look at this next chart, which shows you the long-term returns of the ASX. Now, this is why you should have more exposure to those growth asset classes, because despite the volatility that we can see in a shorter condensed period, the longer we stretch it out, you can ride those bumps, and at the end of it, you'll come out on top. So that's why you should have more growth assets in the portfolio. Now, for people, if you're looking at investing for your kids or for yourself and you don't want to be so hands-on, there's a number of different investment products that you can look at. Of course, you've got managed funds, you've got separately managed accounts, you've got exchange-traded funds, and you've got listed investment companies. On top of this, of course, you do have direct equities as well. Now, they all come with their pros and cons, and there's a lot of things to think about. For example, managed funds typically come with a higher entry point. So if you're wanting to get your child started with $5,000, there's not too many funds that you can actually go into with a minimum investment of $5,000. Most are going to be higher, say $10,000 or $25,000 would be around the standard level. So that's something to keep in mind. Separately managed accounts typically have a lower entry level, but of course you actually own the underlying portfolio. So The big difference there between a managed fund and a separately managed account in this instance is the paperwork required. So at the end of the tax year, you'll get about an 18-page tax form, a document, and whereas compared to a managed fund, it'll be a lot more simpler because you only hold units, and so you just hold one specific pool of units. Whereas with a separately managed account, you actually own all the underlying stocks, and that could range from 4 or 5 to 45, depending on the actual investment strategy taken by the individuals. Now, with exchange traded funds, of course, you can buy these on the market. And what you're doing here, of course, is actually buying a passive investment. It's low cost, but it's passive, and that's going to get you the average return of the say the ASX 200 or the S&P 500, whatever it is that you choose to invest in. By investing in one of those, what you're doing is actually taking out company-specific risk, because instead of buying 3 or 4 or 5 or 20 companies, you're actually buying 200 of them in the ASX 200, or you're buying, say, 500 of them when it comes to the S&P 500. Now, these are, of course, quite a low-cost option, because think about fees, because eventually they will eat away at your returns. Now, they can, if you have an active fund manager, you'll pay fees for them if they perform for you, or if they underperform, you still pay fees. So just keep that in mind. Now, with listed investment companies, they're slightly different to exchange traded funds. They're like a managed fund, but they're actually listed on the stock market, and you can have an opportunity to buy them for more than what they're worth or for less than what they're worth. So just keep that in mind, because the company will be trading on the market. You'll be able to buy and sell shares in that listed investment company, but at times you'll be paying more than what they're worth, and at times you'll be paying less than what they're worth. So if you're happy to be patient and be more active and more hands-on, then a listed investment company might be the good approach for you. These are actively managed portfolios, so their returns will differ from the index or from the benchmark that they're tracking. If you're not comfortable with that, with the potential underperformance, then an exchange traded fund is the way to go for yourself. So things to consider. I did go through a few of these. It depends on how hands-on you really want to be. If you don't want to be hands-on at all, you can just pick up a managed fund or a separately managed account and let the underlying manager do all the rest of the work for you and just completely set and forget it. Same goes for an exchange traded fund. I would hesitate to put a listed investment company in the same category as a set and forget style managed fund, simply because their share price can vary so differently at times to the underlying value of the portfolio, and that's when you want to maybe be slightly more active with your investment there. So if you are looking at set and forget, depending on your particular preference, if it's actively managed or passively managed, you look for a managed fund or a separately managed account. Passively managed, so you're just getting the exchange return, you look at an ETF. And regular contributions. This is important, because if it's a savings plan, if you're, say, like me, and you're putting money aside every single month to invest in your portfolio, you're wanting something that's nice and easy to put more funds into. So just have a think about it, though, because exchange traded funds and listed investment companies, you're buying those funds on the market. So that means there's going to be transaction costs. And even some of the cheapest brokers out there are still going to charge you $9 to $10 per trade. And if you're only putting in, $1,000 at a time, you have to think about how much that $9 or $10 is making up of that $1,000. And so that's, say, an extra percent that investment needs to outperform for you to make up the brokerage costs there. With a separately managed account and or a managed fund, generally speaking, there's no transaction costs related. You just transfer in the additional funds. So just that's something to keep in mind if you are saving. Those brokerage costs doing the transactions for ETFs and LICs can eat away at your returns. On the other side of things, with the separately managed accounts and managed funds, there generally isn't any transaction costs associated with it. However, they might have minimum additional investment amounts. So it might be $1,000 or $5,000 depending. So that could also come into play when you're considering which one to go for. Now, setting up a dividend reinvestment plan, these are quite common and a lot of people do prefer to do this, especially if you're going for a real set and forget style approach. If you are holding an exchange traded fund or a listed investment company, you basically just need to contact the share registry of the listed investment company or the ETF. The share registries, most commonly the names out there are Computershare, Link Market Services, and now Boardroom Proprietary Limited. They're the most common ones, but to find out who the share registry is for your ETF or LIC, just look up that ETF or LIC on the ASX website, and that'll point you in the direction of where the share registry is. Contact the share registry and you'll be able to put in for a dividend reinvestment plan. Or if you already have one and you want to change it, that's who you contact. With a managed fund, typically when you're setting up the structure, it'll ask you what you want to do with your dividends. The default setting for most of them is to have it paid out to you, have it reinvested. If you do want to pay it out to you into an account, you just put that down on the application form. Now, if you are looking to change that or amend that as you go along, just contact the fund. For ourselves, with our separately managed accounts, there's a form on the website that you can do, and we'll change those instructions for you. Now, a lot of people though will also choose to have their dividends paid to them in cash, and then they'll look to redeploy them as they see fit, especially if you're doing a regular savings plan and you've got X amount of dollars going into an account. Well, when those dividends are paid, they'll just of course go into that pool, and then you can redeploy that when you see fit. For example, our investment team will not use a dividend reinvestment plan when they're buying stocks and holding stocks. The reason for that is because they want to buy stocks that are undervalued when we're managing our clients' portfolios. And so a dividend reinvestment plan, you don't get the option of setting a price target that you want to buy something at. You just get given the price that they say. And so we actually want to get the cash and we want to redeploy that when we see fit. Sometimes it's not even into that company, or a lot of the time it's not even into that company, it's into another undervalued opportunity. So that's why you might not want to put in a dividend reinvestment plan in place as well. So when it comes to specifically investing for children, now just keep in mind that minors cannot actually buy shares. They can't own shares personally. What you can do is you can buy shares on behalf of the minor. So basically what you need to do, if you say are going to open up a stock broking account to trade shares in the name of the child, or if you're looking to open up a managed fund or a separately managed account, on the application form, what you would do is you put your name down and then as trustee for then the child's name. That just creates a very simple trust structure. The shares are then held in trust for the child. And now there's a few different ways that you can pay the tax on this, and there's a few different implications to this. So this is where I'm going to refer to the disclaimer once again. This is general advice only, and do seek the advice of your accountant if you are going to go down this path. Now, you can then, once you have set all this up, when the child does turn 18, you can then transfer the shares to the child, and they will then have to pay, if they go and sell the stocks, they'll have to go and pay, of course, the capital gains tax on those. So to the tax considerations, as I was referring to, if a child earns more than $416, a tax return will need to be completed. So if you've got yourself listed as trustee for the child and you've put the child's tax file number in there, because they can get one of course, if they earn more than $416, they will need to complete a tax return. If you're investing for a number of children, you might be better off setting up a family trust, and that way you can distribute who actually gets what income, and therefore might not have to put in a tax return. They could come out of that $416, but do go and seek advice from your accountant or financial planner before, of course, looking at that option. Now, the tax-free threshold for a minor is $416. So anything over that, $417 to $1,307, tax payable on that amount is 66%. Now the reason why it's so high is because it's to deter people from hiding assets in their child's name. Now anything over 1,308 is taxed at 45%. This is if you've got the child, yourself as trustee for the child with the child's tax file number in there. Now the alternative is to not put the child's tax file number in there and your own, and that way you'll pay the tax on any of the dividends and any of the capital gains for the time being. Now, and it'll be charged at your marginal tax rate. Now, once again, putting the disclaimer back up, do go and seek advice on this, because if you are investing on behalf of the child, but with your details in there, it could potentially impact any, say, social security benefits that you might be receiving from the government. So do double check that before you go ahead and do it. And of course, the last dot point states that. Now, if you are looking at an InvestSMART product to invest in for your child, as a number of our clients have, they've come to us to set up growth portfolios for them. There's a couple of different portfolios that are more high growth than the other ones that we have. Now we've got our equity income portfolio and our equity growth portfolio. These are two portfolios managed by our Intelligent Investor Analyst team. The Intelligent Investor Analyst team are hand-picking individual stocks here to beat the market. Their benchmark is the All Ords Accumulation Index, and that's what they're trying to exceed, and that's what they have exceeded since inception. Inception was roughly around this time 2 years ago, so the 31st of July 2015 was inception for those two portfolios. And they're 100% ASX listed investment portfolios. So you're not getting diversity across multiple asset classes, you're getting one asset class with our investment team picking what they believe is the best opportunities in that asset class. On the other hand, we've got the core growth portfolio here, and this is a blended portfolio of Australian equities, of international equities, property, cash and fixed interest. So you're going to get a blended return. It's not going to be over the long run. There's a good chance that it probably won't outperform the equity growth and equity income portfolios. But what it will do is reduce the volatility. It's going to be far less volatile than those other 100% Australian equity hand-picked portfolios. On top of this, something new that's just coming out right now as we speak. We're just launching our small cap portfolio, which is once again ASX 1 listed stocks, but our analyst team at the Intelligent Investor is specifically hand-picking individual small cap stocks there to outperform the Small Ords benchmark. So that is a managed fund, but it does have a relatively higher minimum investment of $25,000. So maybe not something to put the child into just yet, but you know, if they're quite a lucky grandchild, then maybe. So do keep that in mind. That's another high growth option that we now also have that's just opening up. For more information on that, jump onto the website, onto the Invest With Us section, and you'll be able to see all the portfolio details there. Now, what I'm going to do is just quickly jump across to any of the questions that have been rolling through, see what we have there, and if there are a few, and there are a couple. There's quite a few. Elaine says, I've been trying to discuss investments with my daughter. Her and others in her age bracket appear to be incredibly risk adverse, considering shares/ETFs as lost money rather than wealth planning. Do you have any wise words for me to talk to her? Look, it's a difficult conversation, Elaine. And it's quite interesting that that kids do, the younger people do actually think that shares, etc., are quite risky, and I think just more education is needed. Perhaps start them off slowly. What I really do enjoy reading myself personally, and I think what will connect with some younger people, say in their 20s, early 30s, are the blog posts from the Intelligent Investor investment team. The blog posts are free, so anyone can read those, and you can feel free to send them to anyone as well. And they have a lot of great little wealth tips And there was one recently written about investing for your self-managed super fund, investing for your super, and just having a look if you're in a balanced, conservative growth or high growth setting, and just telling you the implications of those. So perhaps I would recommend signing up to that to receive those blogs. They are free and they're a really good place to get started. Especially for kids as well, there's a lot of great content on Twitter and on Facebook from a number of portfolio managers out there who I'd happily point them in the direction of. I think just getting them comfortable and maybe if you've got a share portfolio yourself, setting one up for them. Alternatively as well, the InvestSMART, on InvestSMART we've got our free portfolio manager. So perhaps you can get them tracking a handful of, say, exchange traded funds or listed investment companies, something where you don't have a whole lot of volatility. So they're not going to see those huge swings and gyrations on a daily basis. You don't want to get them into some like speculative micro caps, especially if they're risk adverse. So perhaps look at some ETFs and listed investment companies and put together a little portfolio for them just to watch and maybe paper trade in the investment in the portfolio manager section of InvestSMART. That could be a great way of just starting the conversation, but it's quite a hard one to have. Steve asks, what is the entry point for one of your model portfolios? Currently, Steve, the entry level for the model portfolios is $10,000. We do have discretion to take less because investing for a child, of course, $10,000 is a relatively high benchmark. So please get in touch with us and we can have a conversation about that. Steve also asks, can our grandchildren transfer direct equities out one day if they want to self-manage? Yes, they can. So you just do a transfer of ownership form with your broker. It may come with some costs, it may not, depending on the individual broker. And then they can continue to manage the portfolio and hopefully not sell down all of your hard work. Gretel asks, does InvestSMART have performance fees? Gretel, InvestSMART does not have any performance fees. All of our products, except for the small companies fund, the new small companies fund, do not have any performance fees. So it's just all the flat investment fee, plus we do charge transaction costs, which the brokerage is very, very minimal there. It's 33 cents per transaction plus 0.05% of the transaction value. So it works out to be quite minimal. And talking about portfolio turnover, we don't go out there and churn our portfolios, so we don't create a lot of brokerage. Average portfolio turnover, average holding period for stocks in the Intelligent Investor Income portfolio and the Intelligent Investor Equity Growth portfolio is approximately 4 to 5 years. So we don't turn over those portfolios too often, and we're more long-term holders, so therefore we really minimise the brokerage costs there as well. But there is, in that small companies fund, Gretel, there will be a performance fee that's going to be 10.25% of the performance above the Small Ords Accumulation Index. So that'll be, of course, all available via the product disclosure statement for that fund on our website. Brad says, over the long run, will the brokerage on these investments just negate any capital growth or income received? I hope I maybe just answered that question there, Brad, by saying we very rarely... We're not overly active in churning the portfolios and trading positions in and out. If you like a brokerage for us, it's 33 cents per transaction, and we can also net the trades. Basically, which means if, say, a portfolio is selling down a particular stock and a portfolio is buying it, we can cross the trades, and there's just going to be then the 33 cent cost of that. There's not going to be any actual brokerage, which is the 0.05%. So no, we like to keep the brokerage really low, and for ourselves internally, that this helps us not eat away at any returns. If you are investing outside of us and buying individual stocks via CommSec, E-Trade, NabTrade, or wherever you are, then it is a consideration. And so you do have to consider when you are buying stocks by parcels large enough to negate those brokerage fees. Esmeralda asks, my husband and I aren't overly fond of traditional DRP, not too many people are. how does the income and dividends get reinvested across the models? I know a lot of people aren't fond of dividend reinvestment plans because as simple as they do seem, they can give your accountant headaches because a lot of people don't track them very well, and it can turn into a lot of little mini transactions over the years. So what Esmeralda's asking here is, how do we use the dividends when they come back into our model portfolios? Basically, they'll come back. We don't use dividend reinvestment plans. What takes place is the dividends are paid by the individual companies. It goes into the cash component of the portfolio, and then as that cash weighting increases, if it goes over our, say, cash weighting, which might be 7%, if it goes to 9%, then that's exceeds our weight limit there, and then that means that other investments will have decreased slightly in the weightings. So then that cash will be redeployed across them to the most underweight positions. That's how it, or of course, if we do go out and buy another position into the portfolio, we'll do so from the dividends that come in. Now, for individuals out there who are wondering though, you can have those dividends paid out directly to you into a cash account of your choice, so they won't go back into the portfolio. So it's completely up to you. So those dividends won't necessarily instantly trigger a transaction though when they come into the cash component. We do have a minimum transaction amount, and that's to stop any small transactions taking place where the dollar value just doesn't make sense compared to, say, the brokerage and the costs of doing so. So that's what we do have, that mechanism in place just to protect the portfolio from that automatic buying scenario where the cash component becomes a larger portion of the portfolio. It looks like I've answered all the questions there, so we might look to wrap it up. But if you did wish to find out a bit more about this, feel free to contact myself. My email address is m.snedden, that's SNEDDON, @investsmart.com.au. Alternatively, there's a little chat box down in the bottom right-hand corner of your screen. It'll be a little green icon there. Click on that, and we're there to have a conversation with you right now. So if you were to do that now, we could be chatting in the next couple of minutes. But for now, once again, my name's Mitchell Snedden. Thank you for joining us, and we'll catch you for another live webcast. Cheers.